Welcome to our final video presentation on the capital asset pricing model. We had some presentations on theory behind the model, and we had some presentations on practical application, risk-free rate, beta, and market risk premium. Now we want to be aware of some uses, limitations, and alternatives to the model. The thing we have to understand about the capital asset pricing model is that the differences between diversifiable and non-diversifiable risk matter for making investments. Discount rates on risky investments vary from about 1% above the risk-free rate for very low-risk corporate debt, for example, A-grade corporate debt, to about 20% above the risk-free rate for high-risk private equity investments. So depending upon the risk of some particular investment, your discount rate could end up being somewhere between 3% and 22% at a 2% risk-free rate, depending upon the risk of the investment. So we've got these big fluctuations in discount rates. But even for very risky investments, like early stage technology investments or medical research, discount rates don't keep rising to very high levels. We don't use 30%, 40%, 50%, 60% discount rates in valuation because they're too high. Now you will see some people plug that number into a spreadsheet. But typically when they're using a number of 30, 40, 50, 60% in their computations, they're not doing expected cash flows, which is a weighted average of all the possible cash flows. They're not using some proxy in a scenario even for what they might expect on average. They're typically applying that very high discount rate to estimate of expected cash flows, which is a really successful outcome. So for example, you might see someone analysing an early stage technology or medical research company that says, if we have lots of success, and so we have a large number of users of our technology, or a large number of patients that can be treated with a particular drug, if we have success and we can generate high amounts of revenue and cash flow, that's a great outcome. And we'll apply a 50% discount rate to that success case to do a valuation. But that's not the average case. It's not a normal case. They're not accounting for all of the possible adverse outcomes. Maybe no one uses the technology, or maybe the medical research doesn't cure huge numbers of people, so you don't generate huge amounts of revenue. So when I say that discount rates don't normally go anywhere above 20%, what I mean is that if you apply the discount rate to the average possible outcome from an investment, they don't go above 20%. This means there must be some constraint on discount rates that reflects investors' ability to diversify. Some individual investments are very, very risky. But even though they're very, very risky, my discount rate for the highest risk investment that I can come up with, maybe 20%, it's not that much different to the discount rate that I would have for a well-diversified investment in listed companies of around about 9%, because as an investor, I can hold a well-diversified portfolio. And so even though there can be astronomical risk associated with any particular investment, the discount rate is not going to be at an astronomical level. And that is because of investors' ability to diversify. So that idea behind the capital asset pricing model, that systematic risk is going to be important and asset-specific risk is going to be relatively less important because of investors' ability to diversify, that idea holds. But what doesn't hold is that the capital asset pricing model as a pure model of estimating discount rates works. It doesn't work the way that researchers, when they came up with the model in the 1960s, would have hoped it would work. And that's because, in reality, the violation of assumptions that underpin the capital asset pricing model are substantial. Investors can't borrow at the risk-free rate of interest. Investors don't all have the same expectations for expected returns, volatility, and covariances of returns amongst pairs of investments. Investors don't have the same information set. There are market frictions which lead to reduction in trade. There are transaction costs. There are taxes. Investors don't have the same set of information. And these violations means that there is at least some reasonable chance that risks other than systematic risk actually matter for coming up with asset prices and therefore expected returns. But to justify an alternative equation, we need a theory as to why a violation in at least one of those capital asset pricing model assumptions leads to a different model. Otherwise, there is a risk that something else shows up as useful just by chance. Now, what this means is that you can't just trawl through historical data, look at which investments earned high or low returns in the past, and say, well, that thing necessarily is a risk factor which we should account for in discount rates. Because researchers have shown that there is an enormous amount of risk factors which you can show had a high correlation with returns in past data, but aren't a viable estimate of a risk factor which can be incorporated into a model. We need a theory as to why some particular risk factor is going to be relevant in addition to systematic risk. Now, some of those theories might be as follows. A clever researcher, Professor Black, said, you know this theory you've got that all investors can borrow at the risk-free rate? That's not true, right? And this theory is violated, and the implication of that theory, once we do some mathematics, is that instead of having the baseline for the discount rate be the risk-free rate, Professor Black said, you know, actually the baseline is going to be something else. It's going to be some input which is above the risk-free rate of interest, which he called the expected return on a zero asset portfolio, some asset that has no systematic risk. So in short, what he showed is that in his model, because there was this violation of the assumption that investors can borrow at the risk-free rate of interest, the expected return on a low beta investment should be above what's predicted by the capital asset pricing model, and the expected return on a high beta asset should be below what is predicted by the capital asset pricing model. And in fact, that's what actually appears in the data. If you run a regression of asset returns, stock returns and market returns, you'll see some industry relationships present. Utilities have low beta estimates, typically about 0.6 or 0.7. Technology stocks have high beta estimates, typically 1.2 or 1.3. If you actually compare the capital asset pricing model prediction of returns on utility stocks versus the returns technology stocks actually earn, the returns actually earned on those utility stocks are above what's predicted by the model. If you look at expected returns on technology stocks as predicted by the model versus their actual returns on technology stocks, these high beta stocks, are below what is predicted by the model. So it turns out that Professor Black's idea is true. It turns out that this violation of the assumption that investors can all borrow at the risk-free rate of interest means that the capital asset pricing model is, in fact, biased. Low beta stocks earn returns above what's predicted by the model, and high beta stocks earn returns lower than predicted by the model. Another problem with the capital asset pricing model is that it's imprecise. Beta estimates vary markedly over time and across similar firms, as we saw when we compared beta estimates using Wednesday to Wednesday returns and Friday to Friday returns, for example. Using the same window of data, say 5, 10 or 15 years of data, but just shifting the day at which we define to be a week from Wednesday to Friday, we saw fluctuations in beta estimates. In fact, some researchers and we did that computation for all Australian listed companies using all available historical returns. And we found that if you take the biggest beta estimate for any company across those 5 different beta estimates you could get based upon 5 different definitions of a week, minus the smallest beta estimate you get, the average gap between the maximum and the minimum beta estimate from those 5 definitions of a week you could get across all stocks is 0.2. So on average, someone might have an estimate, a beta estimate, which is misspecified by 0.2 simply because of that person's preference for Friday or Monday or some other particular day. We also have wide error in the estimate of the market risk premium. Sure, we can look at historical data and that gives us a baseline, but we only have a sample of historical returns, even in the United States, of around about 100 years of some reasonable quality. The reasonable quality data only goes back to 1926. And so we've got less than 100 years of data, and we could well be misestimating the projected market risk premium based upon just random stuff that happened in that historical time period. Furthermore, even if there's no implication that in the future things are going to be the same as in the past, because we have different economic regimes. We have a different Federal Reserve mandate. We have fundamental changes in the workforce. We have fundamental changes in the integration across economies. So even though we want to start with historical data as a baseline, things can be quite different going forward. So we've got noise in the historical data and the broader question about whether that historical data is useful at all. But that's what we have to live with, the imprecision. And finally, the capital asset pricing model is incomplete. We know other risks matter for asset prices and therefore discount rates, and these risks are ignored by the model. So 4 risks which we know with a high degree of confidence actually matter for asset prices and therefore returns are liquidity. Private equity companies trade at lower prices compared to publicly traded companies, and therefore private equity returns, even before you account for the skill of private equity investors, on average are going to be higher than returns on publicly traded companies because they are less liquid, and investors are going to receive some compensation for that exposure to a lack of liquidity. We know that a lack of information or poor quality information affects asset prices. When companies provide poor disclosure to investors, or they are inconsistent in their disclosures, or they develop a reputation for providing biased or opaque information to investors, their shares trade at a discount to other comparable firms. So a lack of information lowers share prices and therefore increases expected returns. We call that information risk. Financial distress matters. We know that companies that on average are likely to be more exposed to financial distress trade at lower prices to otherwise similar companies. That's ignored by the capital asset pricing model because in theory these are all diversifiable risks and they don't count in that theoretical world. And finally, some companies have an inability to invest in a downturn. Lots of people's intuition is that bricks and mortar type companies, say manufacturers and utilities, these companies are very stable, secure companies because they've got physical stuff. They make investments and those investments retain value because they're physical things. But those companies aren't necessarily safe companies just because they own stuff. Because to run your factory or utility, you have to achieve economies of scale. It's not just owning a factory, which mitigates your risk. You have to actually, and generates profits, you have to actually optimize that factory and run it at a fairly high capacity. If you're only operating a factory at 50% of capacity, you've got a huge fixed cost there in terms of depreciation, which you're not recovering by efficient utilization of that factory. So companies that have lots of their money tied up in physical assets, like manufacturers or utilities, they can't really disinvest in a downturn because they can't sell half the factory. They have to run the factory at a low proportion of capacity in that downturn, which means it's very hard for them to cut their costs. So, for example, in the current shutdown of the US economy, the automakers, Ford, GM and Fiat Chrysler, are shutting down production in their factories. That's going to reduce their costs associated with labour, but it's not going to reduce their costs associated with depreciation of their equipment. Those costs remain. Whereas someone in the services industry that has a higher proportion of costs attributable to labour, that company can disinvest in a downturn by laying off workers. So its ability to reduce costs is enhanced. Airlines is another application. Airlines either own aircraft or they lease aircraft under long-term leases. But either way, there's a fixed charge associated with depreciation or there's a fixed charge associated with leasing. Those airlines internationally are not flying at present. Capacity is substantially reduced. So yes, those airlines can reduce their operating costs by reducing the hours of their workers, but they have a big fixed cost. They can't disinvest in a downturn. Who's going to buy the planes? So these risks matter for asset pricing. They are not accounted for by the model because the model says these are all diversifiable risks and therefore they shouldn't count. But they do. What's the theoretical basis for these risks actually mattering for asset prices? The theoretical basis is that investors don't have the same expectations for risks, expected returns and covariances, and investors aren't all operating with the same information set. And once you deviate from those crucial assumptions, then it's possible to have these industry and company-specific risks actually matter for prices and therefore discount rates. So in short, the capital asset pricing model is biased, it's incomplete, and it is imprecise. But there is hope. Now there are other models, and I've just listed 3 of them on the slide, and I have got my heading saying not for assessment. I'm not going to ask you questions about these models at all, but it's important that you're aware that the capital asset pricing model is not the only way of estimating a discount rate. If you poll students who've taken an introductory finance course and say, what do you remember from that course? A huge proportion of those students will simply say, yeah, I remember something about beta and the capital asset pricing model. As if that was the focus of the course, and it's not. It's just one equation used to estimate a discount rate. And we introduce it because we've got to start somewhere. If we don't start with the capital asset pricing model, which is a very simple model to actually implement, I can teach you how to estimate the risk-free rate and beta in the market risk premium. If we don't start somewhere, how do we progress to something more sophisticated? But that doesn't mean that we have decided as researchers that it's a really great model. It's not. It's not a great model for application, but it gets us thinking about the idea of discount rates and systematic risks, and it gets us started towards coming up with reasonable discount rates. Alternative models, and there are others, this is not a complete set, are the black capital asset pricing model, which, as I mentioned, just shifts the intercept term to the expected return on a zero beta asset, and then shifts this market premium to be market return minus the expected return on a zero beta asset. And because the zero beta return is greater than the risk-free rate, and it is less than the market risk premium, that shifts upwards the cost of equity for low beta stocks and shifts downwards the cost of equity for high beta stocks. So that model addresses the bias in the capital asset pricing model. Another couple of researchers, Professors Fama-French, came up with what is known as the 3-factor model and the 5-factor model, in which they introduce more risk factors. In the 3-factor model, this model was based upon the observation that small stocks and stocks with a low ratio of book value of equity compared to their market value of equity have higher returns than predicted by the capital asset pricing model. And that's because that small stock characteristic and the low book value of equity compared to market value of equity, that should just read stocks with a high book value of equity compared to market value. Small stocks and stocks with a high ratio of book value of equity compared to market value of equity have higher returns than predicted by the capital asset pricing model. And that's because these small stocks and these high book to market stocks are stocks that researchers have determined are stocks that are more exposed to financial distress, they're more exposed to an inability to disinvest in a downturn, and they're more exposed to a lack of information. So those characteristics, size and the book to market ratios, are proxies for information risk, inability to disinvest in financial distress, and on average they earn higher returns. And the Fama-French 5-factor model added in another couple of risk factors, and they were based upon the observation that firms with low asset growth and stocks that have high return on equity, that is profitable firms, seem to earn returns which are higher than predicted by the capital asset pricing model. The low asset growth variable suggests that firms that are not investing a higher proportion of their earnings, returning more capital to shareholders, seem to earn higher returns. That's the growth investment seems to be a proxy for low risk. They're mature companies and they're lower risk. Whereas these firms that are returning money to shareholders, these are firms that are not necessarily got great opportunities for future investment. Firms that are highly profitable seem to earn higher returns than predicted by the model. Firms that are highly profitable in terms of return on book equity also seem to earn higher returns than predicted by the capital asset pricing model. And the label that Fama-French assigned to those was robust firms. They have a specific factor called robust minus weak profitability. The low asset growth proxy, their specific risk factor they refer to, is conservative minus aggressive investments. Their analysis suggests that firms that have robust profitability and that make conservative investment choices, they're actually reasonably risky firms and therefore earn relatively high returns. The higher return on book equity is a proxy for being in a company or industry that is taken on high risk. The low asset growth is a proxy for having relatively conservative investment, and therefore these investments might on average earn higher returns in fact than firms which are being more aggressive and therefore moving down the spectrum of positive net present value projects. So that ends our presentations on the capital asset pricing model. It ends on a sour note because I said it's not a particularly useful model for analysis, but we have to start somewhere. It has limitations in that it's biased, imprecise and incomplete, but we're going to use it for computations. You're going to use it in practice. Just be aware not to place too much faith in your capital asset pricing model estimates. Don't stick rigidly to the idea that it's going to give you great estimates of discount rates. And importantly, don't deviate by substantial variation from your expected return on the market portfolio return, because there is a risk that all of your great analysis could be undone by having unreasonable values, asset values, influenced by unreasonably high or low discount rates. Be careful about having discount rates which you believe are too far away from the expected overall market return. Coming up next, weighted average cost of capital. I look forward to that discussion.